Welcome to another Real Estate Talk Show, featuring highlights of the best interviews from our national real estate radio show. Here's another property expert.
This morning the show is all about Q&A, questions and answers for the experts, and we've got a couple of questions to do with research. Kent Lardner from Pricefinder is the man we always turn to. We're talking about research and what's happening in the market. Good morning, Kent.
Good morning, Kevin.
Kent, let's deal firstly with an email that we received from Sue. And I've got to say that this is probably the one segment we receive most emails for, but we've filtered out and we've got time for two. This one from Sue at Surface Paradise. I've heard you talk about the number of houses on the market and the stocks, the months of stock. I think that's what you call it. Yes, it is what we call it, Sue. How do you calculate this, and at what point does it impact the selling price, and do the same rules apply to units? A very good question, Ken.
It's a wonderful question. I'm quite surprised in Australia we're not more widely using it. The US market, the appraisers or valuers over there use it, the lenders ask for it all the time, and the realtors use it. So it's a fairly common measure there. What we do, we estimate how many properties are selling each month. Now, typically how we do this is we look historically, and we look at some of those graphs over the last year or so. Now, a couple of important things here. If you're looking at the last few months, you've got to allow for the fact that the data's still trickling through. So the last 2 months aren't going to give you an accurate figure, but if you look back, say, 3 or 4 months, and then also look at, say, this period last year, you'll get a fairly good idea of what's selling per month. So that's the starting point. Let's just say we calculate there's around 10 sales per month. The next thing I'll do, I'll go and look at how many houses or how many units for that suburb are currently listed. And you go and do that by looking at a few of the larger portals, and you tally those up. So if I count, say, 50 listings, I simply divide 50 by 10. That's 50 listings divided by 10 sales per month, and I'll come up with an estimate of around 5 months of stock. Now, Kevin, what we use as a general rule here is anything under 3 or 4 months of stock is likely going to lead to some upward pressure on price because there's a lot more buyers than there are sellers. And typically then we also look at the other end of the scale. Anything above 9 months, we find that there could be some downward pressure on prices because there's a hell of a lot of listings there, but not a lot of buyers.
So do the same rules apply to units?
Absolutely. So it's exactly the same thing. In some of the markets where we've got a lot of stock and a lot of diversity, some of those more dense markets, we actually even divide it a little bit further. So at the simplest end, we divide it by houses, and we do it for houses, and we could divide it by units. But if you want to get really fancy, you start to look at the different price brackets and look at how the stock levels are working for very expensive properties and how they're working for less expensive properties. But we won't focus on that for now. The main thing is, yes, it can be applied for houses, and yes, it can be applied for units.
Wonderful. Sue, well, I hope that answered your question. We've got another question. This one comes from Graham at Caboolture. I recently bought a report through, and I won't mention the name of the company, it's a data supplier. He was trying to calculate the value of his property, similar to what you do in the show. He then got a report from Pricefinder, and they're quite different. Now, why is this, and which one should I believe?
Yeah, sure. Kevin, this is a fairly common thing. There's a couple of important differences or things to highlight here. Computer models or automated valuation models are purely where the computer blurts out a price and the user has very little input or interaction with the result. Now, the Pricefinder system does offer that as a starting point only. So we use that, what we call an AVM, and we produce that. But what we also do is allow the user to interact. Now, what you can typically do is remove a sale if you think it's an inappropriate sale in the final 6, and you can adjust for the quality differences. So what we do is we present 6 properties and say, are they better or worse than my property? And you move sliders around to say, is that better or worse, to optimize the result. Now, the difference with that and an AVM or a computer model can be significant. If you're in an area where there are significant quality differences between properties, some rundown properties, some nice new properties, you find the computer models will struggle. But by using the sliders and using user interaction, you can certainly return estimates very close to what the professionals can come up with using Pricefinder.
Well, Graham, what you did, the data supplier you mentioned to me, and I won't mention their name on air, but they actually use the modelling, the AVM model, where you don't get the chance to interact, which is what Kent was just saying. So for my point, purely a personal preference, I think you should be looking at the Pricefinder model, which is what we use in the show here, because it gives us so much more versatility in terms of determining what the price is. Hey, Kent, thank you very much for your time.
Thanks for the opportunity.